So this was from early Jan this year. A couple of interesting things to note here. We've got our call strikes here at a 13.71 delta, 14 delta. But in order to get sort of in the middle of the structure, we have to go with a higher delta on the puts. So sometimes you have to do that. 20 delta here on the short puts. Now that happens quite a lot in index options. So the Qs, SPY, IWM. So in order to get an equal distance roughly between the short put and the short call, it's about 5.5%. This is they're about the same, I think. This calls are maybe slightly further away, but we've actually still got negative, slightly negative delta. I don't know if you can see that, negative 1.32. So even though we've got a higher delta here, we're starting with slightly negative delta, but we always want to make sure we're sort of on top of that hill. Then if we roll forward, it wasn't until about January 22nd, 23rd. We're looking pretty good here. What's happened to all our strikes? There they are. Looking pretty good here. We're in a nice little profit of about 11%. We're still in our zone. We're not falling too far down the hill, but it is starting to look like it might roll. And that hill's getting much steeper now as we get closer to expiration. But we're in profit of about $83, 11%. Then the next day, the Nasdaq continued moving up 1.28%. You can see here now we're getting quite close to those short calls. The delta here has almost hit 25. It's about 24. And we're really going to start rolling down that hill if the Nasdaq keeps rallying. Just going to see if I've got the actual adjustment trades in here. No, I don't. Okay, so what we can do in this case, let's look at a defensive adjustment. We're still in a slight profit. We received plenty of premium. There's plenty of premium remaining in the trade, so we've got a little bit of profit to play with, a little bit of premium. So we're going to buy back that spread, leaves us with just the put spread, and we're going to roll it out. Let's try here. So the blue line is before adjustment, the green line is after adjustment. So we've reduced our profit potential, but the trade-off is we've got more room to the short strike now. It's cost us a little bit of money to make that adjustment. And then if we move forward, Nasdaq starts to come back into the middle of the zone. Pretty big down day. Right back into the middle, still up about $60. And we're still sitting, that's today or yesterday. This is a problem. This is the one bad thing about this software. It doesn't give you today's data. Yeah. See, when you go to today, it's going to spaz out. All right. So in any case, we're sitting right there at the moment. So sitting really good. We're at $48 profit. We've still got another $100 in premium remaining or profit potential remaining, but we're looking pretty good. Delta 5, so that's very low, and a delta 11. So no adjustments needed on this one at this stage. So does that make sense? The defensive adjustment, you kind of understand defending the tested side or doing an attacking adjustment with the untested side. I'd be more inclined to do an attacking adjustment early in the trade, and then as we get closer towards expiration, that's when we want to be playing defense. All right, let's go through some butterflies. Okay, so I've got to add the weekly options, do I? Let's have a look. All right, so this was a pretty short-term trade. You can see there, weekly options, so only about 8 days to expiration. Goldman was at about 383. We've centered our structure at 385, so more or less at the money. Flat T plus 0 line. Sorry, let me just pause and answer this question. Vivek says, if we normally close spreads before hitting full profit, does spending more money on rolling if needed matter? I say this in context of you saying our profits went down by rolling. I mean the profit potential. Yeah, so if it cost you, in that example, I think it costs us about $57 to make the adjustment. That reduces our profit potential by $57. It doesn't actually change our profit at the time. It just changes the profit potential in the trade. Let me know if that makes sense. Okay, so let's move forward day by day. We're looking pretty good. Looking pretty good. And on the 7th, really nice, we close out. So no adjustments on that one. Pretty simple trade. That one worked really well. Let's look at another one that did require an adjustment. Okay, this one's a bit more of a more standard one. I think this was better. What are we at? 340. Yeah, there we are. So it was much wider because it was longer to expiration, 22 days. So similar to what we're looking at now with about 21 days to expiration. One funny thing about butterflies, even though it's kind of centered, we're not on top of the hill. The top of the hill is actually here. That's one of the peculiarities of butterflies. And we've got negative delta overall. So a little bit strange, but that can happen. The delta is blue on the bottom, Subash, because it's positive delta. If the stock goes down to this level, we have positive delta because we want the stock to go back up into the profit zone. If the stock goes up here, we have negative delta because we want it to go down. So at the moment, we're slightly negative delta. If we're on top of the hill, we're pretty much delta neutral, right? So that's a nice little thing as well. It'll kind of show us what our delta will be for certain prices of the underlying. All right, so let's move forward. Adjustment points if we hit the break evens, right? Sitting pretty good, up about 14%. Probably could have taken profits here, to be honest. And then we started dropping. And I'm going to have to go back 5 minutes. Right. Now the next day we drop and we hit our break even point. So now we're going to add a second butterfly centered at 320. We're going to extend out our profit zone and we're going to flatten the top and it's going to look more like a condor. Right? So now we're right back in the middle. We've added extra capital to the trade, no doubt about it. A little bit of a risk, but we're more central. We've extended our profit zone all the way down to 314 and we're back on top of the hill. See how our P&L, I don't think it's really changed. We're up 13 here. Before the adjustment, we're up 13. So our actual profit hasn't changed, but our profit potential has changed. Our expiration graph has changed. Let's go forward. Still okay, still in the zone more or less. And then looking pretty good here, up 12%. And here was when we closed out up $243 or 17%. So there's a really good example of scaling in with a butterfly. Let's look at another one. October 21. Okay, similar sort of setup. We're at the money. What are we, 365? Let's find our strikes. There we are. So this was the regular monthly expiration, 29 days to expiration. We're short the 365 calls and we're long the 385. So 20 points wide. Looks pretty good, pretty standard setup. Let's go forward day by day. Down 9%, down about 15%, hitting the outside of the zone. I think we stayed with it. And we're getting out, so we're going to adjust if it hits the 385, I think. I think it was sort of the next day. Yeah. So there we go. We're sitting here and we're going to do another scale in. So we're going to center another butterfly at 385. So many strikes here. So you're going to see this one change, becomes -2. Now we're in the condor shape. We've extended our profit zone out. So pretty cool adjustment, right? Trade slowly comes back our way. Still down a bit here. And just need SPY to pull back a little bit. And then I think it happened about here. And then the next day, right back into the middle of our zone, 22% profit. Vivek says, do you keep the wings for the butterflies at the expected move? No, not necessarily. The expected move will be around the 15 delta. So the wings of the butterflies I'm usually putting at 25 delta is a pretty good spot. So that'll be slightly inside the expected move, yeah. All right, now I've got a really good example of a broken wing butterfly. Okay, so here's our NVIDIA broken wing butterfly. Where are our strikes? About 400. I think I used puts. Usually use puts for broken wing butterflies because the short strike is below the market. And we just got to find, there they are, the monthly, 44 days to expiration, nice flat T+0 line, limited risk on the upside, more risk on the downside. Now, this is when NVIDIA was going through its massive bullish run. So I wanted to have low risk on the upside. And what I think from memory happens is NVIDIA charges higher all the way up here, but we've got, see that T+0 line, we've got really low risk. We're not actually going to lose much money. And then we scale in. Then I think we did a roll up. So there's a couple of little adjustments here, but let's go forward. Slight profit. Yeah, here we go. So with this one, I scaled in. So again, I'm going to add a second broken wing butterfly. Can see here on the 4th, we bought, where's our strikes? These are our strikes here. Creates that kind of flat top that we're looking at. Still got a little bit of risk on the upside. We're going to get rid of that shortly. Overall, we're perfectly delta neutral. And then you can see that with that flat T+0 line. We'll go forward. And then I think it keeps rallying. We're a slight profit here, not really seeing much P&L. We've got our big profit zone below the market. Eventually, we want NVIDIA to kind of pull back a little bit towards that profit zone. And that tends to happen even on stocks going on massive bullish runs. Eventually, they'll have a little bit of a pullback at some point. You want to just keep that profit zone just below where the stock is. So we're rallying up. We're not really seeing much impact in P&L. And then on this particular day, what I did from memory was we rolled up the short puts. So there's one of our short puts at 420. I think we rolled it up to 430. So we bought this one back for 610. We sold that for 780, credit of $180, and that removes any risk from the upside here. So because we get $180 credit, everything kind of moves up $180. And we've added risk on the downside, obviously, but we've still got our profit zone here. And it doesn't matter how high NVIDIA goes now, we're not going to lose any money. And then it wasn't until about December 5th, you can see it keeps rallying, but it doesn't matter to us because we've got no risk. And you know what? Let's add some more lines here and kind of see how the trade's going to progress over time. The closer we get to expiration, we actually want it to come down into that zone. And let me just fast forward a bit here. Wasn't until sort of December. See, now we're looking pretty good. We can actually make some profit if it comes even not inside this profit zone here at expiration. We're going to make some profit if it just comes down here. And I think eventually it did have just a little bit of a pullback, up 113, up 105, and then there, boom, up $208, and we get out. So, little example of, well, few examples actually, of butterflies and broken wing butterflies. Vivek says, in that case, aren't butterflies more risky than iron condors? They can be more risky than iron condors because they're more narrow, but they tend to have a bit of a flatter T+0 line. So in the short term, they're less risky in a way. Let's see if we can look at an example with Tesla. There's our Tesla butterfly, pretty flat T+0 line. If we were to do a standard iron condor at the 15 delta, All right, so let's say, let's try and remember these numbers, or I'll write them down. With the butterfly, if Tesla drops to 380, we're down 50. If Tesla rallies to 420, we're down about 40. Let's compare that with a condor, risking about the same amount, $500. Let's reset that T+0. 380, oh, we're only down 25. So yeah, it actually is still a pretty flat T+0 line on the condor as well. So yeah, but we've got more margin for error on the condor. So yeah, I would say butterflies may be a little bit more risky because they're quite narrow. All right, let's bring in our last strategy, the trapdoor. Now, this is a strategy that's more for advanced traders with a bigger account. So I wouldn't worry too much about this if you're a newer trader. It's pretty commission intensive as well because it requires quite a few moving parts. It's designed on the Russell, but it can be done on IWM or big cap tech stocks like Microsoft, Tesla. But the trade was built on the Russell. What we do is we go about 20 points below the current market. So we'll say 22.90. We're going to go 20 points wide. And what we're going to do there is buy a debit spread. So the opposite of what we normally do. I'll show you why in a minute. Then we're going to choose our strikes similar to how we would do a condor, 15 delta. We're going to go 20 points wide. And then on the call side, normally we'd want about a 12. We're not getting enough strikes here. Might have to use Feb. Let me just check. Yeah, I think I'm going to have to use Feb. Okay, sorry about that. So call strikes are going to be around the 12 delta, 20 points wide. Our puts, roughly 20 points below, 20 points wide. And our put credit spreads, roughly 15 delta, 20 points wide. Okay, so we can get rid of all of those. All right, so I've still got some things in here from the butterfly, I think. But first step is we go 20 points below the market and we buy a put spread. And we're actually gonna do two of those. And I'm gonna just get rid of some of these other strikes that we don't need to clean it up a bit. Okay, so that's the first thing we do. We buy a put debit spread. Oh, that should be -2. All right. Opposite of what we normally do. We normally do credit spreads. We're buying the closer in one, we're selling the further away one. We're going to do a normal credit spread on the calls. Don't worry about the risk graph yet. And then the put spreads, again, same 15 delta. And usually it's going to be about 7 contracts. This piece is a little bit variable depending on what the delta is. We want to try and get it close to delta neutral. So if we go with 6, we've got negative delta dollars. If we go with 7, we've got positive delta dollars. I think I'm going to go with 7 because we're going to generate a bit more premium that way. So there's our risk graph. So it's a bit of a combination between sort of a condor and a broken wing butterfly, where we've got a little bit of income potential. We're risking 9.5 grand. We could make 500 if it stays flat, and then we want to have that at least 5%. So 500 over 9,500 is about 5.26%. So that meets that criteria. And then we've got this profit zone on the downside, less risk on the upside, and a nice flat T+0 line. So this trade works really well. It'll actually perform better than a condor if the stock or the index makes a big move. You might find that the condor's already under pressure and needing to be adjusted, whereas the trapdoor might be totally fine and not need an adjustment. So it moves a little bit slower than a condor. We've got a little bit less income potential for the flat stock price, but we've got this nice profit zone on the downside. And ideally, what we want to see is as we get towards that expiration date, let's say a week before expiration, you can see where our profit line looks. And then eventually we can sometimes get lucky as we get right towards expiration, it drops down into this zone here. So look, I wouldn't worry too much about it, but it's just a little preview of some of the more advanced things you can do with options once you get a bit more familiar with them. This has been a really good trade for me over the years. Really slow moving, really flat T+0 line, and it kind of combines the elements of a broken wing butterfly and a condor. I call it a trapdoor because this is like a little trapdoor into our profit pit. So this little debit spread that we buy is a trapdoor leading into our profit pit. Like I said, sometimes you can get lucky and you might end up in this zone right near expiration. Very similar trade management rules to a condor. We're going to watch this delta here and this delta here, and if either of those hit 25, we're going to do a defensive adjustment or delta hedge, something like that. We're going to set alert points, usually about halfway down the profit zone. We want it to get into the profit zone, but we don't want it to get there too early. Yeah, similar adjustments to condors. If we come down here into this zone, oops, sorry. If we get down here too early and the put strikes get to a 25 delta, we can take these off, play defense, roll them lower. Likewise, if the stock rallies up, we can take these off, roll them up. And then you can always delta hedge as well. You'd have to delta hedge with IWM, which does make it a little bit tricky. But yeah, delta hedging is possible as well. So we'll follow this trade along till the end of the month. We'll see how that goes. What other trade did we add today? Tesla Butterfly. So we'll add that one. That'll be our trade. We're going to watch our butterfly, and we'll set some alert points. I think I said 380 and 420. And then on the Russell, our alert points are going to be about 2240 and about 2375 on the upside. All right, let's go through a couple of past examples, and you'll kind of see how they work out. July 28. All right, so this is actually using IWM, similar sort of shape, similar structure. Let me get rid of the weeklies. There we are there. So we've got the 6 contract put spread, we've got the 2 contract debit spread, and there's our call spreads up at a 10 delta, 16 delta there, and that is 192, a couple of dollars below where it closed at 194. So let's go forward day by day. I think this one, from memory, I don't think this needed any adjustments. Just kind of stayed in the range. Already up about 5%. Looking pretty good there. Starting to look good, about 11%. I think it was around here we closed out, up about 11%. So that was a nice easy one, didn't need any adjustments. I think I've got one on the Russell that did need an adjustment, so I'll show you that one. Okay, so again, similar looking structure, nice flat T+0 line. We're on the middle of our hill. What are we at? What's our put? 1600. There's our strikes there. We've gone 7 contracts this time on the puts. There's our trap, our debit spreads. And there's our call spreads up the top. And from memory, May 13th, I think, was when we needed to adjust. So not much happened early on in the trade. They moved pretty slowly. Even though the index has made a 2% move, it hasn't really impacted our P&L that much. You know, we went from up 150 to still up 110. Big move in the underlying, but didn't really impact us much because we're still on top of that hill. Moving pretty slowly, slight loss position now, back to a gain. Looking good. Still looking good. And then it was about here. I think we took profits here. This one actually didn't need adjusting, sorry. 635. The next one I'll show you needed adjusting. Up about 7%. So we closed out here. And I want to just show you, I'll keep moving forward to show you how it progresses, even though we did close it out on that date. So pretty slow moving. As you can see, it's not really, we're getting some big moves in the underlying, but it's not really impacting our P&L all that much. You can see how that T+0 line's starting to change now. We actually want it to come down into that profit zone. Right, so now we're up about 12%, about $1,000. What prices would I start adjusting? If we go back to the original trade, about halfway down the trap zone, so about 1675, and then on the upside, about here, halfway between the stock price and the short strike, about 1830. Those would have been my decision points. All right, last example. As I said, you can do this on stocks like Microsoft, Tesla. I need to get the right date. October. Okay, so similar setup. Our call strikes are a little bit further away. Could have possibly brought them a little bit closer in. They're at a 12 delta. That's okay. There's our trap. And there's our regular 15 delta put spreads. And let's go forward day by day. I'll actually just fast forward a little bit quicker here because not much happened with this one early in the trade. It was quite long expiration date, so not a lot was happening early on. Again, down 3% here this particular day, and the trade's barely changed. We're up 47. Stock makes a huge move lower. We're up 66. It hasn't really impacted the trade. Up about 4%, up 5%. And I think it was here. November 3rd. All right, so what we did here was an adjustment where we rolled the puts up. So let's go back here. So you can see here we're getting closer to our strikes up the top, but they're totally fine. They're only a 14 delta, so we don't need to play defense. But these puts here are basically not doing a lot for us. They're at a 5 delta, and that spread's only worth, if you can see that, 17 cents. So what we ended up doing, overall we've got negative delta. We took these off and we rolled them in. We did an attacking adjustment. So these are going to come off and they're going to roll back up closer, I think back to a 12 delta. Yeah, so we rolled them up there. Brings in an extra credit, lifts the income potential of the trade, but shortens our trap zone because Microsoft was pretty bullish at the time. And then I think we ended up closing a couple of days later. Yeah, I think we started to close out around this point when it was up about 5%. So have a great rest of your day or your evening, and I'll talk to you again soon.